Happy Monday, option strat traders. So I'm going to toss a trade at you here today. Again, all trades that I'm putting out there are designed to be made in paper. These are learning processes that I want people to go through. So what we're going to look at here is a relatively simple trade that many people are going to be familiar with, an iron condor. And I'm looking specifically at doing this in the QQQs. So, which, as most people know, is the ETF for the tech sector. It's kind of the equivalent of the NASDAQ, but in a stock or an ETF format. So if we look at a chart, each one of these bars represents one day. If we look at a chart of the QQQs, you can see that we are in what's called an uptrending flag. So this flag kind of shows us that at least for the foreseeable future, we're likely, not a guarantee, we're likely to trade somewhere between this, 322, maybe even up to 323, 324 range, and possibly down to, maybe the 310, somewhere in that general range. That would be kind of a logical expectation in the coming week or two. We can also see, looking at volatility here, that the implied volatility on this is still up a little bit compared to the historical volatility. Now, the comparison of those two do tend to make for a slightly more favorable option selling or credit type trade, which of course selling an iron condor is that type of trade. So let's take a look at why that is. So again, I'm kind of looking at maybe the 324, let's call it 324 to maybe 310 range. So I'm going to come in, we're going to do a neutral trade. I'm going to select an iron condor. And then this is our iron condor that we're looking at. Now, something that I want to show you, I'm going to go back just one step here. And I want you to look at this particular window right here. This is a really cool window to look at. The max return versus maximum chance. Okay, now I also, let me first of all just back this up a little bit. Again, I'm looking to play here over the next week or two, so I'll move this to April 26th. So this thing's going to expire in about 2-3 weeks, somewhere in that general range. Now, let's just take a look at what happens here. So if I move this to a maximum chance, in other words, that's a maximum chance of making some level of profit. So what would a trader need to do in an iron condor if they wanted the maximum chance of having some level of profit? Well, you're going to widen out the condor, okay? In other words, you're going to go way, way out, and you're going to sell your short strikes really, really far away, okay? And that means that the market, if the market stays anywhere between whatever this is, 296 and 338, which is a really, really wide window for a couple week trade, if the market stays in that range at expiration, we will make $2, okay? So kind of not worth taking that risk. It is a high probability trade. We have the maximum chance of having a winning trade, but if you're only going to get $2, what is that worth? And you're going to have commissions in that, and you're going to have slippage in that. So again, you've got a 97% chance of having a winning trade, but is it really worth it at that point? We call this picking up pennies in front of a steamroller. So this works, and you pick up $2 every time you make this trade, most likely, until the day you don't. Now, the day you don't, and the market has a massive event, you could be down $200. So you could do 100 trades here, picking up $200, and if one of them goes south, which it probably will, again, you've got a 97% chance here. So there's a 3% chance it's going to go south. So if one of those 100 goes south, you've lost all your profits. Again, This is not factoring in commissions and slippage. So that will further create that problem for you. So let's look at our maximum return. So if we wanted to get a total maximum return out of this, well, shoot, we can get into this trade to where our maximum loss is only going to be $19. Our maximum return is going to be $317. But look what has to happen. We have to stay essentially in a window of, near as I can tell here, like 316 to 318 for a 2 to 3 week period of time until expiration. So we have to stay in a 2-point window, or at least be in that 2-point window at expiration in order for this to happen. So there is a 15% chance of that happening. And if it does happen, it will give us a very good return. However, I think we also have to look and say, yeah, that's pretty darn unlikely to happen. So let's go back to our visualizer now, and let's take a look and see how we might adjust this so that it's a trade that might make some logical sense. Again, we were talking about maybe going down to 310, that the market could potentially go as low as 310 on us. And let's see, I think we were saying to the high side here, we were picking around 320 to 325, somewhere in there. So we could do something like this. That is a fairly logical condor that might make some sense to do. We would have a gain of around $200. That's our 223 credit that we take in. That's the maximum amount of gain that we could have. We could lose $227. We need the market to stay in this general window for that to happen, and we need to be in that window at expiration. Now, I personally don't carry most of my trades to expiration. I like to get out of them before expiration. So if this were a live trade I'm doing, again, I'm not recommending that. I'm recommending a paper trade. But if this were a live trade and I got into this trade, I'd be looking to get, 15, 20%, maybe even 30% out of this. That's 30% of my risk, by the way. So 30% of my 223 risk, that's going to be about $60 or so. So somewhere here over the next, if we march our timeline forward here, somewhere maybe by April 19th, somewhere in that general range, and a little bit further it looks like. So maybe around April 20th, this might have decayed. Again, this decay is a theoretical number, but I might have decayed at that point and still be in this general window where I can get out of this trade with my $60 in profit. So that's how I would lean toward trading it. Or if I was trading multiples of these, let's say I was trading at 10 lot, I might peel one of them off at a 10 or 15% profit. Then I might peel an additional one off as profit got a little bit higher. And maybe I have one of them that I carry all the way to expiration. That's another way that you can trade these things on a fairly regular basis. So I'm going to go ahead and save this trade. And we'll call this QQQ demo paper trade. And I'm just going to call this a simple iron condor. And of course, this is a paper trade that I urge people to make and play with, experiment with it. I'll put the link in the below the YouTube video here as well, so that you can take a look at that link also. You should be able to just click on that link and open up this exact same trade in your platform, and then save it as a paper trade there as well. So that's it for today. Just going to look at a basic iron condor in the Qs. Take care, everyone.